All right, welcome to the deep dive. Today, we're going to take a look at a company called Datadog.
Okay.
So ticker symbol DDOG. We want to look at it through the lens of Warren Buffett's value investing principles.
Mm-hmm.
So we've compiled a value analysis for you guys, some news articles, financials, all the good stuff, market research, and we want to see if this cloud observability and security leader could be, a long-term Buffett-style investment. So for everyone listening, the goal here is to kind of see how a tech company, a modern tech company, measures up against these, tried and true core value principles.
Uh-huh.
And we want to give you some insights into tech investing without sort of, overloading you with information.
Yeah, no, I think that's a really interesting premise because you're taking, classic tried and true principles, but applying it to a relatively new company in a rapidly evolving space. So I think that's a fascinating way to think about this.
Yeah, and I think one of the most important things for us to figure out is this a value stock or a growth stock or, is it a value trap? I mean, there's a lot of different things we've got to figure out.
Right, right.
So let's just dive into the business model first. They're a software as a service company, so SaaS, a subscription-based model, which delivered a very predictable 86% of their $2.2 billion in revenue in 2023. So it sounds like, once customers are in, they kind of stay. So why is that stickiness so important from a value investing perspective?
Well, I think you hit the nail on the head when you said predictable.
Right.
That high customer retention, which is driven by significant switching costs, becomes a key advantage because when you think about it, a monitoring solution is deeply, deeply integrated within a company's critical infrastructure. So to migrate away from that, to switch providers would be a major undertaking. And, when we talk about their comprehensive suite of products, spanning observability, security, all these different areas, it really cements that stickiness. So, it's what they call a land and expand strategy. Get the customer in with one product and then just sell them more over time. And that makes them an increasingly integral vendor, a much harder vendor to move away from.
Right. So it makes it very difficult to switch.
Yeah.
Yeah. And the market they operate in, observability, it's projected to grow significantly. I mean, all these reports that we're looking at, it's a huge addressable market, but it's a crowded space. I mean, there's big players already in this market. So how does a company like Datadog, how do they stand out? How do they differentiate themselves in such a competitive environment?
That differentiation is so crucial. And you're right. I mean, the market is littered with giants, but Datadog has really carved out a unique space as a leader in observability platforms. Now, one thing that we've seen in the research that I found particularly interesting was their ability to help companies navigate these really complex regulatory landscapes, things like GDPR, IPA, all these acronyms, PCI, DSS, FedRAMP.
Yeah, I saw that too.
These are big deals. And Datadog's features, they actually help with compliance in these areas, and that can be a real differentiator. I mean, think about it. If you're a company and you're trying to navigate these complex regulations and you have a vendor that can help you do that, that's a pretty big selling point. And then the other thing is just the sheer complexity of setting up a comprehensive observability platform, the integrations, the sheer number of integrations that are required. I mean, Datadog, they have over 850 integrations. So, for newcomers, that's a huge barrier to entry, and it really strengthens Datadog's position in the market.
Yeah, and it creates that network effect.
Absolutely.
Right. Where they've got all these integrations with all these companies. So, if another company's trying to come in and compete, I mean, they've got a lot of catching up to do.
Yeah.
So, it's not easy to replicate that.
Yeah.
What makes their competitive advantages, though, truly durable? I mean, we've talked about some of them already. The switching costs, the integrations. Their brand is strong. I mean, they're a recognized leader in this space, and having a lot of multi-product adoption, as you mentioned, leads to these really high switching costs. Is there anything else that gives them an edge, like a lasting edge that you see?
Yeah, absolutely. You hit on some of the key points, but one thing I'd add is just their continuous innovation. I mean, over 400 new features just last year. And then you combine that with their unified platform, which allows them to correlate data across different functions. I mean, that's a significant technical hurdle for competitors to overcome. They're not just offering point solutions; they're offering a platform that can really give you a holistic view of of your entire IT infrastructure. And then, we can't forget about AI. I mean, AI is everywhere these days, and Datadogs, they're really leveraging it. Features like Watchdog, these AI-powered features really enhance their offering and make it even harder for customers to replicate or replace.
Right. All right, so let's talk about the management team. I mean, the co-founders have been at the helm since 2010. They've overseen substantial growth. I mean, they seem to really know what they're doing. The company's doing very well. They're very transparent. I mean, with their reports and their earnings calls, and they seem very focused on both employees and customers, which, we like to see. And they're heavily reinvesting in R&D. So, how does this management style, how does it align with what Warren Buffett looks for in a company?
Well, Buffett is all about, competent, trustworthy management with a long-term vision. He's not looking for short-term gains. He's looking for companies that can, stand the test of time. And I think, Datadog's management, the fact that they're reinvesting so heavily in R&D really suggests that focus on future growth, and maintaining that competitive edge. So, yeah, I think it aligns pretty well with Buffett's, long-term perspective.
Okay, so let's get into the financials. This is where, rubber meets the road, right? So they have a $37.9 billion market cap as of, end of March 2025. Their price to earnings ratio using GAAP is really high, around 212. But, if you use the non-GAAP, it's much lower, around 60.
Mm-hmm.
Revenue grew 26% last year, but it's projected to slow down. Their guidance for this year suggests maybe 18% to 19% growth, which is still good. I mean, that's still pretty amazing.
Yeah, it's not bad.
Yeah. High gross margins, that's great, but their GAAP operating margin is much lower.
Yeah.
And, part of that is because of stock-based compensation. Now, they just recently took on some debt, $1 billion in convertible senior notes. So they, historically they were debt-free, but they took on some debt end of last year. But, the good news is they have strong cash flow. I mean, $775 million in free cash flow for fiscal year 2024. They ended the year with $4.2 billion in cash. So, they're sitting on a lot of cash.
Mm-hmm.
What stands out to you from a value investing perspective when you look at these numbers?
Well, the first thing that jumps out is that deceleration in growth, despite still being significant. I mean, 18%, 19% growth is nothing to sneeze at.
Right.
But combined with the high valuation multiples, it does raise some questions about, the margin of safety.
Okay.
And, as Buffett is very disciplined about not overpaying, even for excellent businesses. So that's something that I'd be keeping a close eye on. And while their free cash flow is strong, that GAAP profitability is less impressive due to factors like you mentioned, that stock-based compensation, and that can dilute shareholder value over time.
Mm-hmm. All right, so the market sentiment around the stock seems, generally okay. But the recent guidance, the slower growth projection did cause some concern. I mean, the stock price, dipped a little bit. But, it's still trading at a pretty high valuation. Analysts still have, price targets that are, much higher than the current price. There's a lot of institutional ownership, over 70%. Short interest is low. What does all this tell you?
Well, it tells me that there's still a belief in the long-term potential, of the company. But the market is clearly sensitive to any signs of slowing growth, especially at this valuation. When a stock is trading at a premium, investors expect to see, continued high growth to justify that premium. And when that growth starts to slow down, even a little bit, it can make investors nervous.
Right. They want to see those earnings.
Yeah.
Okay. So let's just kind of wrap up our assessment here. Datadog strengths, definitely a market leader. They have a strong platform, that recurring revenue model, that stickiness that we talked about.
Mm-hmm.
Weaknesses, definitely that high valuation, the slowing growth, although, still pretty impressive growth. Increasing operating expenses, some of that's due to, stock-based compensation. And then, just, they have a lot of products. They're kind of getting to a lot of different areas.
Yeah, it's a complex business.
Yeah. So, cost management could be a challenge.
Mm-hmm.
Opportunities, definitely. I mean, the market is expanding.
Absolutely.
There's still a lot of room for them to grow,
Mm-hmm.
Within existing customers, cross-selling, upselling, AI observability, cloud security, they could make some strategic acquisitions or, partnerships. I mean, there's a lot of, things that they could do. Threats, always increasing competition, potential for an IT spending slowdown. I mean,
Hmm.
if the economy slows down, companies might cut back on IT spending, rapid technological change. I mean, this is a very fast-moving space. Cybersecurity risks are always a concern. And then the potential for, open source observability solutions to gain traction. There are some open source alternatives out there.
Right.
So applying Buffett's principles, and particularly that need for a margin of safety, what's the takeaway here?
Well, I think Datadog has many of the characteristics of a strong business with a durable competitive advantage. The management team, the market position, the financials are generally pretty healthy.
Hmm.
But that current valuation, it just makes it difficult to see a significant margin of safety. And that's a cornerstone of Buffett's approach. He's all about buying, wonderful businesses at a fair price. And right now it's hard to say that Datadog is trading at a fair price given, the slowing growth and the high valuation multiples.
Right. So it sounds like, Datadog is a very compelling company. They're doing a lot of things right.
Huh?
But the price tag, might be a little too rich right now for a strict value investor.
Yeah, I think that's fair to say.
It might be more of a hold or something to watch for, a better entry point. Maybe, if the price comes down or, if their growth accelerates again, it might be more attractive. So a final question for you guys listening, how does the potential for, continued high growth, albeit at a slower pace, balanced against this premium valuation, how does that fit into your own investment strategy and your own timeline in this really fast moving tech world? Are you willing to pay a premium for growth, or are you looking for, more of a value play? So that's something for you guys to think about. And yeah, that's it for today's deep dive. We'll see you next time. Thanks for having me.